A lot's changed in the last few months. Interest rates have fallen, we've got lower petrol prices, and the Australian markets rallied hard in the early part of 2015. Helping me to navigate these interesting times, I have Geoff Wilson from Wilson Asset Management.
Hi, James.
And John Abernethy from Climb. John, welcome.
Welcome.
Geoff, we'll start with you.
Yes.
You had a pretty cautious outlook on 2015, but markets have charged ahead.
Yes.
Rates are lower.
Yes.
How are you viewing the change?
I mean, we're cautious for a reason, and the reason we're cautious because all the companies we're seeing were telling us that the domestic economy was finding it incredibly difficult. There was virtually no economic growth that we could see from the mid and small cap companies we visited, and that is why interest rates have been cut. And we've seen the first interest rate cut, and really it's a reflection of how poor the economy is, and I think there'll be at least another one or if not two interest rate cuts from here. And what we'll see is the lower interest rates, the lower Australian dollar and the lower oil price will all be stimulatory to the economy in the second half of this year. And that's why the market has rallied ahead. It's anticipating that growth coming through in the latter part of the year.
John, are the moves that the RBA have taken, are they enough to stimulate activity, particularly from companies in Australia?
Well, they'll stimulate. Whether they're enough, I don't know, but I agree with Geoff, there'll be another cut. I also think the Aussie dollar will drift lower, but not at the same rate it has. I think it'll slow down, but it'll end up somewhere towards 70 cents at the end of the year. You've got to remember that at this time last year, when the currency was sort of mid-90s, the risk of recession in Australia was high. Now at 75 to 78 cents, that risk has been taken off the table. As Geoff said, interest rates cut, petrol prices down. You've gone from, say, a 40% chance of recession to now, say, a 20% chance. And the market's doing what it normally does. If recession's off the table, markets rally. So it looks reasonable from this point on for the market.
Okay, so with interest rate cuts in mind, lower petrol prices and a lower Aussie dollar, where would you expect to start seeing green shoots or positive signs in the economy? Where would you look to for those sorts of pieces of information?
Oh, look, I don't think it's going to be greatly positive. I just think it'll mean that we don't slip into a recession. It just means that we probably grow at around ex-inflation 2%, 2 to 2.5%, so way below normal. We will see unemployment kick up. So you'll still see some negative headwinds. It's not going to be a great period, but as I say, we're not looking at earnings dropping 10 or 20% in a recession. We're now looking at earnings going 0 to +5. The problem is now with interest rates where they're set in Australia and overseas, the temptation is to overpay for stocks. And you can justify it based on bond yields, but from a valuation perspective, it's very stretched. And every time you go up a hill, you come down the other side at some point. So we've got to be careful we don't go to the peak and look over the other side too quickly.
And the problem with going up the hill is you tend to go up the hill very slowly and you tend to come down the other side very quickly in the equity market. So
what sort of things should we be looking for to see what the top of the hill looks like? What are some of the risks?
Well, I mean, the risk, as John said, is just overvaluation. The market always moves 6 to 9 months in front of a pickup in economic activity, and that's what we're seeing. I mean, one of the things people forget is the incredible leverage that you can see from a pickup in revenue. So, say a company that earns $100 has $80 of cost, so it's making a $20 profit. If revenue picks up 5%, then it goes from revenue goes from $100 to $105. Then profit goes, if they can keep their cost base down, which they normally can in the first stage of a pickup in the economy, then profit goes up 25%. So on a small revenue growth, you have phenomenal leverage on the bottom line. Now we're not seeing that. All the reporting we're seeing, this reporting period that we're in, I think is pretty mixed. But I'm expecting that pickup. We'll see that pick up in the latter part of the year. The tough thing is, it's all being priced in now.
We had a booming year for IPOs last year.
Yes.
We thought that might be tailing off and the opportunity closing potentially for a period of time at the end of last year. Yes. Has this environment changed that?
Definitely. Yeah, my view was last year, because my view on the market was negative, because it was really a reflection of the economy, and I didn't think the Reserve Bank would cut. I thought they would be being stubborn. To me, I think it's fantastic they have cut, and it's clear that they're signalling they're going to cut again. And I think the cash rate might come down to 1.75%. I also think the Aussie dollar, with the US rates, will probably be increasing in the latter part of this year. The Aussie dollar is easily going to go down. It'll have a 6. It could be 65, something like that. But in terms of the IPO market, everyone will be, with the strong equity market over the last month, everyone who wanted to float anything will be looking to get it onto the market as quickly as they can.
Okay. John, quite topical at the moment is offshore buyers looking at Australian companies. M&A likely to also be a theme this year?
Well, it's scary when you see capital flowing out of Japan. I mean, they're printing money and they've got interest rates of 0, and the post office is getting deposits where the people pay them money to hold their deposits. So this is one of the flow-ons of quantitative easing, and in 20 years of a mess in Japan, you've got a bond market which is yielding 1.5% below inflation. Quite amazing. So Australia's got to watch itself. I mean, this is one of the reasons why you could see some silly prices being paid in the stock market. If foreign capital buyers who are buying businesses trying to get out of their currency, which is being printed, want to buy real assets in real economies like Australia, you get businesses like, say, Toll Holdings going for 50% premium, and then you've got to start thinking, what else can go here? Now, if the Australian government's not going to regulate capital flows, and they've shown a propensity not to do it, with free trade agreements, and we just signed one with Japan, you're going to get a situation potentially where money flies into this country. I'm surprised it went for an operating company like that, but if they're going to do that, there's a lot of other companies which could get knocked off. But certainly the property market in Australia, which is still showing a reasonable yield in this region, is going to be a big target, and some of the big funds might be come into play.
Yeah, and I mean, it's interesting. Going back to the toll takeover today, it was really normally takeovers are about 25% premium, and this was like I would call a kamikaze takeover because it was bang, 50% premium. There's going to be no negotiations. That's the price. We're going to give you a full and high price. And there's going to be no competition for the bid. Yeah.
And all that money's got to come back into the market.
Exactly.
So everyone says, that was great, what am I going to buy next?
Yeah.
And everything's up there at 20 times earnings. It's a very difficult situation.
Yeah. So we're going to talk about some stocks in a minute, but if we're going to throw data at a dartboard and where we finish 2015, what are your views on the market?
I'd probably now say up 10% from here. Yep. And but the stronger part of the year would be, I would say, the first half of the year, even though the economy will be picking up in the second half. But I think it'll all be priced in. It'll be priced in this in the next 3 to 4 months.
John?
Yeah, unfortunately, I think Geoff's right. I mean, the market's going up. We said that pick the currency and pick the interest rates, you can pick the market. So it looks like we've got 2% or lower cash rates. We've got a currency going towards 70, if not lower. That means that the market probably goes through 6,000 at some point in the second half of the year, which feels good to own stocks, but we all know that it's not based on fair value, it's based on interest rates.
So keep an eye out for when we get to the top of that hill.